The market is changing, which means your investment strategy has to change too. And so perhaps you should consider investing in mortgage notes. And this is why. Hi, I'm Jillian Sidoti.
And I'm Dodson. And today we're going to talk all about performing and non-performing notes and why it's important to think about this direction given some of the changes in our economy. You know, I can tell you right now, Wall Street is not buying private loans.
Okay, when you say private loans, what kind of private loans do you mean?
So what I mean is really the types of loans that are available for everybody to invest in individually. Meaning like the hard money loans, the higher interest loans for real estate flips, for bridge developments, for I know some great guys that make a lot of loans to people that may not have access to the U.S. banking system. They are just regular secured residential real estate loans, but especially in Texas, in the south of Texas, people are shut out of the banking system. So they're really relying on these private lenders and private loans.
Okay.
And so traditionally what's been happening, and I've been really involved with this over the past decade. At the time, about a decade ago, these loans were just at a high interest rate. And what happened is through the years, that interest rate went down more and more and more and more to the point that it was basically zero. And honestly, there was a lot of push out of the hard money lenders and the private lenders only because it just didn't make sense. It really made more sense to invest on the equity side. Who filled that gap was a lot of private equity firms and Wall Street that were buying the loans from the originators and from the mortgage companies rather than the private investors being able to participate in it. Right now, though, the interest rates are still going up. And ironically, Wall Street has quit buying, which is actually creating a new opportunity and new market for the private lenders to get back into the space. And just to kind of explain, why get into it if Wall Street isn't interested? They're generally the smart money. Well, it's because all Wall Street's doing is waiting for the interest rates to come down again, which really sounds weird, but they want to lock in a higher rate. As the interest rate's going down, the value of their loan goes up. They're really only doing it because they're looking to trade. These loans are getting bought and sold nonstop. But what it doesn't change is if you're actually looking to invest for long-term income and actually hold on to these loans, you can get really amazing interest rates right now that you haven't been able to get over the past 6, 7, 8 years, just because inflation's happening, the treasury's increasing that interest rate. As long as you're looking to hold these loans, you can get really amazing return. You still have the lender default risks there, but right now there is a lot more opportunity in that space than there has been in recent years.
So let me see if I understand this correct. There's originators of the loan. The companies are originating loans as a hard money loan, as a bridge loan, what have you, but then they sell them off. And that allows them to go out and make a new loan and originate more loans, right? And my guess is that they're making money on the points and not so much the interest because they're selling the loan. So they keep the points, sell it off, and the remaining.
Oftentimes they make points and they keep a spread.
Okay.
Where maybe they made a 8% loan, but they sell 6% loan to a private equity firm. So they keep a point or two spread in there. Plus they're keeping origination points. So that has a domino effect of ruining I wouldn't say ruining, but halting people's business, right? Because the originator isn't originating because they have nowhere to sell them off to. So they can't originate anymore because they ran out of money. And then developers can't develop. So what do you think the outcome is going to be? Oh, it's just as it always goes with the shifting of the markets. I still love the real estate space, but I don't think we're going to see that continuing growth in the price points like we have over the last few years. And that's okay because markets shift. And I think we will start seeing, and I think we're just kind of at that cusp of a shift of the private investors more towards the lending space in a higher priority position than the equity side, really because the interest rates are so high right now that it just makes sense. if you're just trying to get that reasonable annualized return. I mean, what are the mortgage rates at right now? Let's see. Last I saw, they were at like 6.5%, but they keep changing. All right. A 30-year conventional loan, the APR on average right now is 6.4%. I mean, that's huge. When 2 years ago, it was like 2.5. The cost of the loans has shot up exponentially, which that has a negative pressure on the valuation of the real estate, because anybody that's buying it, they're leveraging stuff up and they've got to pay these rates. But now on the flip side, 2 years ago, if you were a private lender, maybe you were getting 3%, 4% interest rates, and it's higher generally than the 30-year fixed rates to do these shorter term bridge loans. But it was very competitive because other people could go out and borrow the funds at 2.5%, and they're still loaning it out at 4%. So they're getting a great spread in there at that low value. And this is starting to happen now where, it's 6.5%, but these bridge loans and these shorter loans are now at 9, 10% annualized interest rates. So there's a bigger spread in there to actually make money. Yeah, it costs more to borrow the money to make the loans, but there's a big enough spread in there that sometimes it makes sense. Now, the one thing that I'm saying is don't run out and mortgage your home to get a bunch of money to buy other loans, because that's caused issues back in 2008 while I was living in Vegas. That wasn't a fun time. But there are opportunities out there if you're already investing long-term for your retirement.
So the idea is that there's going to be some notes available to buy.
There definitely are. Yep.
Okay. What should people be looking for in buying notes, and why should people buy notes? Let's start with the why should people buy notes in the first place?
Sure. If you're buying promissory notes in real estate that are secured, they're generally first lien secured. If they have a subordinate position to other loans, you have to more evaluate it like in an equity investment because you're more at risk. But you have this secured position where you have a fixed rate. The borrowers have to pay this fixed rate. And if they fail to make payments, you can take the property back or you can sell it through the foreclosure process. So there's generally a debt to equity. You don't loan 100% of the value of a property. Now, if you're going into the market, maybe it's 50 to 70% debt to equity. So if somebody quits paying day one, you go and take that property back, you foreclose on the property, you're actually expecting there to be a 30% gain from the foreclosure. That's not necessarily yours, but you at least know that there's this padded protection to make sure that you get the interest and the payments that you expected to begin with, and the default payments and the late payments and everything else through that process. So it does become a lower risk investment compared to just being a buyer, where the lender is really, they have that superior position to yourself. If you can't make the payments, then you lose 100%, where the lender actually can get some coverage.
All right. So I've invested in I've invested in mortgage notes before during the last downturn. And they turned out really, really great. And I just want to define a couple things for some people out there. We have a difference, right? We have performing notes and non-performing notes. And a performing note is a note that is, still paying as agreed. Maybe a bank or a lender just has to get rid of assets. And so they're willing to sell you the note, right? At some kind of, discount, right? So maybe the principal amount of the note is $100,000 and they're willing to sell the note to you for $95,000 or something to that effect, because they need to get rid of the asset and they've already made some money on it. Whatever the case may be, that would be for like a performing note. And then a non-performing note is
just real quick to throw in there. Right now, there's a lot of these origination companies that you don't have to get it from the bank. The originators aren't able to sell the loans to the banks or to Wall Street. Mm-hmm. So it's really expanded the base of people that are looking to sell those performing loans and continue on to those fun and exciting non-performing.
Mm-hmm. Yeah, no, that's right. So tell us about non-performing notes and what you would say to look for in a non-performing note.
Sure. Non-performing notes It sounds crazy. Why put your money into something that's not working? And it's exactly because it's not working. And you can buy these promissory notes at such a huge discount to what their face value is. And that's where anybody that has done this in the past, you know that you don't have to take a performing note that you paid 15 cents on the dollar, $100,000 loan that you bought for $15,000. Well, you don't have to get it performing where it's going to repay $100,000. That'd be a wonderful goal. But if you can get it reperforming for $50,000, all of a sudden you've basically tripled the value of this non-performing note. If you can make it reperforming even at a lower level, and then you have the opportunity to just sit on there with an amazingly massive return. Or again, you can just sell it to somebody that's looking for that performing loan, long-term income. So you have options there, but that's where you get the actual appreciation and growth of the value of the promissory notes, much more than buying into the actual performing loans.
Well, yeah. And that's the thing. For me, I always bought like non-performing notes, and I loved buying non-performing notes, but there is a level of risk, right? You got to be ready, because another big thing about buying a non-performing note is, general risk aside of the fact that you're buying an asset that needs to be rehabilitated, right? There's different laws and rules in different jurisdictions, right? So for example, buying a note in Jersey, which is a judicial foreclosure state, is way different than buying, say, a non-performing note in a non-judicial foreclosure state, like a deed of trust state. Even California is better than buying a note in somewhere like New Jersey. Now, since COVID, it's another thing you want to look into. You want to make sure that any notes that you buy in certain jurisdictions don't have certain new COVID rules that are attached to them in terms of evictions, right? Because you are essentially buying a note and you don't know necessarily who lives in that property unless you do due diligence before you buy the note, right? So let's just say who's living in the property is a tenant who's been paying rent to somebody, and the person who's receiving the rent hasn't been paying the mortgage. And now you have two parties you have to deal with, basically foreclosing upon the mortgagee, right? The person who owns the property, and then the tenant. And you don't know, you have to know the condition of the property, things like that. And then you also have to have a strategy. And your strategy has to be, are you looking to get properties, or are you looking to get cash flow from notes? Or are you looking to rehab notes and resell them?
Without a doubt, investing in non-performing notes takes a lot more skill than just the due diligence of, is it a good asset? Is there a low debt to equity ratio? Is it paying? How to exit, how to rehab, what strategies are there? It is definitely not for the faint of heart, but risk and reward. There's a higher risk for a higher reward going with the non-performing, or at least that's what's expected. If somebody is just watching this and like, oh, that makes a ton of sense, I'm interested in the higher return opportunities, what would you tell that person?
If they're interested in higher return opportunities, I would remind them that risk equals reward. And if you want the highest return opportunity, then your best bet is to buy non-performing notes.
If somebody was to do that, this is a situation that, at least in my opinion, you need to get educated on, or you need to mentor with somebody or get some training. I don't think anybody should just jump out there and say, oh, I can buy this note for 10 cents in the dollar. Sign me up, without really knowing what they're getting themselves into.
Right. I mean, that's a huge part of it. And that's the thing, is like, then you just have like nonsense paper. I mean, you also have to make sure you're buying an actual, like, the property is worth the note. I cannot tell you how many times I've looked at a note and the property wasn't even worth the note. The note wasn't worth the property that secured it. Right. So for example, recently I looked at some notes for properties in California, and you're like, oh, okay, that sounds great. Well, I got news for everybody out there who's not from California. California actually has a bunch of places that are just vacant land, and they're useless vacant land. They don't have any running water. They don't have any utilities. Somebody, some money one time or another on these vacant pieces of land. Maybe they had some big, fancy idea of something that they were going to do, and it never came to fruition, and they stopped paying the mortgage. And so now the note holder is like, oh, I want to dump this note on some unsuspecting person. So that's a big part of it, is you do have to, if you're going to go out and do this, you need to do your due diligence on the underlying properties, what it is you're going to buy. So the first thing I would say, if I'm giving anybody advice on how to buy notes, is number one, do all the research you can about the note market you want to buy in, and really determine what is your own personal objective. Are you looking for cash flow? Are you looking to obtain properties? So through foreclosure, are you looking to help out homeowners? Are you looking to get certain commercial properties? There's all kinds of different strategies you can have. You could also buy seconds. There's still seconds out there you could buy, which sit behind the first. Of course, they're absolutely riskier. I used to have a client that would buy non-performing seconds behind a performing first, which is actually a very interesting way to take advantage of market swings, because when the market goes up, your equity comes back, right? And going to stop performing on that first, because if they stop performing on that first, they're definitely going to lose the property. So you just sit there and wait. You wait as they pay down the first until there's equity there for you, right? So that's another strategy. So you want to determine your objective. What are we looking to do? Are we looking to get cash flow? Are we looking to get properties? Are we looking to, flip these notes? What are you looking to do? So that's number one. Number two, based on what you want to do, what is going on in that market? And can you implement your plan in that market? Like I said, New Jersey in particular is a very difficult state to be able to foreclose on. So, you got to be careful in buying in certain places. And then number three, you got to find the notes. How do you find notes, Nate?
There are brokers and networks that specialize in non-performing notes. There are actually groups that you can join, and looking at it can be, you need to be kind of in the know because the biggest risk is being the newbie when there's the sharks that have been part of these groups and they've been picking and choosing real quick what makes a lot of sense. And then the newbies showing up, hey, I'm interested in this. And it's like, great, here's an opportunity for you to rehab it. So there's definitely those opportunities that are out there. I do know some brokers that they literally just have relationships with banks. You can just start cold calling banks, but if you get one that says, okay, we'll happily sell you our non-performing paper, the brokers or the guys that have those relationships are trying to buy as much as possible and sell what they don't want to keep.
Yeah.
So oftentimes you're already getting with these networks and with these groups, the loans have already been picked over at least once by whoever got it from the bank. And the banks are most likely the ones that are willing to sell at such a deep discount because they have these balance sheet requirements. And if they have too many non-performing loans, they've got to figure out just how to get them off their balance sheet for regulatory purposes. So that's where they really end up coming from.
Yeah. And actually, in my opinion, just go straight to the bank, right? Yeah. Go make relationships with some banks. Find out who to talk to, who's the asset manager over at the bank, and see how you can get some of these, access to some of these assets. Will they call you when they have some notes available? A lot of times, I will tell you this, when you're buying from a bank, in my experience, they'll make you buy more than one note. Like they won't let you just...
They don't want you to cherry pick them.
No. So they'll make you take them all, right? They'll make you take all the notes. So my advice there is to, get a relationship going with a bank, even your local credit union, because it's usually easier to get into those doors. Go into your local credit union, local bank, and see if you can develop a relationship with the asset manager there. Once you figured this all out, determine how much you're willing to pay. Like, come up with your numbers, do some calculations. What's going to make worth your time? Do you want to be paying, for 10 cents on the dollar, or are you willing to pay 90 cents on the dollar? Or, what are you willing to pay and for what kind of asset?
And I think that what kind of asset, it's really where the art of the deal comes into play. Because if something's been in default for a longer time period, the markets have been going down, it really hurts the value of that loan. And if you get like, I really like this one note, and it gets bundled with others, you have to pay attention to all of the assets that you're acquiring. You can't just cherry pick. But that's also kind of you're explaining exactly what I was saying with these networks and these buying opportunities, where somebody goes in and they'll get a strip, they'll get all these assets, they cherry pick what they want, and then they sell the rest.
Absolutely. So, all right, everybody, we'll wrap up here, but just know that mortgage notes offer investors a number of benefits, as we discussed here, including passive income and consistent payments without the daily responsibilities of being a landlord, which, Nate and I know a little something about. So it's not a bad investment, and you really should be gearing up just based on everything Nate said earlier about, what's happening in the mortgage market and the resale market of notes. We're going to see some movement here. The market is telling us we're going to see some movement and there's going to be some opportunities. So with that, I'm Jillian Sidoti.
And I'm Nate Dodson. And this is why.